Most people believe they will clearly notice the moment when their money finally starts working for them. They imagine that one day they will open their investment account and suddenly see a dramatic change. They think there will be a moment when everything becomes obvious and they realize their financial life has transformed. But in reality, compounding never arrives with an announcement. It doesn't send a signal or create a big event. Instead, it grows quietly and almost invisibly. For months or even years, it can feel like nothing meaningful is happening. You keep adding small amounts of money into your investments, occasionally checking your balance, and all you see is a number that moves upward very slowly. There is no excitement, no dramatic jump, and nothing that feels life-changing. Because of this, many people misunderstand how compounding really works. Compounding behaves a lot like a plant growing underground. When you plant a seed, you don't see anything happening for a long time. Beneath the soil, roots are spreading and a structure is forming, but none of it is visible yet. Then, suddenly, one day, the plant breaks through the surface and starts growing faster than you expected. The biggest problem is that most people quit before reaching that moment. They become bored, they panic during market declines, or they assume investing simply doesn't work. Years later, they look back and regret stopping. But what most people never realize is that before compounding truly accelerates, there are subtle signals that begin appearing. These signals are quiet and easy to miss, but they reveal exactly where you are in the process. If you learn to recognize them, something powerful happens. You develop patience. And patience is one of the greatest advantages any investor can have. In this video, we're going to explore 9 powerful signs that compounding is quietly building momentum in your financial life. Some of them may seem ordinary or even disappointing at first, but they are actually early indicators that something much bigger is forming beneath the surface. One of these signs, especially the 7th one, often appears shortly before people experience explosive growth in their investments. The first real sign that compounding is working often feels surprisingly boring. When people begin investing, progress seems painfully slow. Month after month, they deposit money, but the growth appears almost insignificant. They open their account, look at the numbers, and wonder if the effort is even worth it. There's no excitement and no dramatic increase, just a quiet and gradual rise that feels unimpressive. But what most people don't realize is that this stage is where the real foundation of compounding is being built. Every dollar you invest is purchasing assets. Those assets begin generating small returns, and those returns are reinvested to purchase more assets. Over time, those additional assets also start producing returns. Slowly but surely, a cycle begins forming. At first, the numbers are simply too small for the human brain to notice the real power of what's happening. For example, imagine someone who begins with $10,000 and contributes around $300 every month. After 3 years, their account might grow to roughly $18,000, assuming an average return of around 7% per year. When they look at that result, it doesn't seem very impressive. Most of that growth came from their own contributions rather than investment returns. However, the critical thing is that the system is now functioning. The engine of compounding has started running, and once that engine grows large enough, something fascinating begins to happen. In the early years, your personal contributions are responsible for almost all the growth in your account. Your salary funds the investments, and your discipline keeps the system moving forward. But eventually, the balance becomes large enough that the investment returns themselves begin contributing more than you do. Imagine investing $400 each month. In the beginning, your account might generate only $20 in returns during that same month. But after several years, the situation can flip. Your investments might generate $420 or $450 in a single month, even though you only contributed $400. In that moment, your money begins working harder than you are. Your portfolio becomes its own engine for growth. During the early years of investing, people are constantly focused on increasing the amount they invest. They search for ways to cut expenses, increase their income, and contribute more money into their portfolios. Time slowly becomes more valuable than the size of the contribution itself. Compounding rewards patience in a way that most people initially underestimate. Consider a simple example often used in finance education. One person begins investing $200 per month at age 22, but stops contributing after 10 years. Another person starts later at age 32 and invests $500 per month until age 62. At first glance, it appears the second investor should end up with more money because they invested significantly more overall. Surprisingly, that's often not the case. The first investor may actually finish with a larger portfolio because their money had 10 additional years to compound. Those extra years allow returns to build on top of previous returns again and again, creating exponential growth. Once investors fully understand this concept, their behavior begins to change. Another shift occurs around the same time. In the beginning, market downturns feel extremely stressful. When the market falls and the value of an investment account declines, many investors feel anxiety and question whether they made the right decision. However, after witnessing multiple recoveries over time, investors start recognizing a pattern. Markets decline temporarily, but eventually recover and reach new highs. When the next downturn occurs, the emotional response begins to change. Instead of fear, there is curiosity. Instead of panic, there is opportunity. Investors begin seeing lower prices as discounts rather than disasters. A market drop of 15% means the same investment can now be purchased at a significantly lower price. When the market eventually recovers, those discounted purchases often generate larger gains. This shift from fear to opportunity is a major psychological milestone in the compounding journey. In the early stages of investing, the returns are so small they barely seem noticeable. A few dollars appear as dividends or gains, and the impact feels almost meaningless. But compounding does not grow in a straight line. Instead, it accelerates over time. As your investment portfolio grows larger, the returns begin growing with it. Eventually, a surprising realization occurs. One day you examine your account and notice that the returns generated during a single month could actually cover one of your regular expenses. Perhaps it could pay for your electricity bill or a portion of your groceries. A few years later, it might be able to cover your car payment or even your rent. This moment represents a powerful psychological shift. Imagine a portfolio worth $200,000 earning an average annual return of 7%. That portfolio would generate approximately $14,000 per year, or around $1,160 per month. That money appears without additional work, overtime hours, or salary increases. It is produced entirely by the assets you own. Realizing that your investments can support a portion of your lifestyle changes your perspective on money. Financial security begins to feel more attainable. At the same time, another interesting sign begins to appear. Your investment account balance starts surprising you. In the early years, you usually know what your balance should be because it mostly reflects your own contributions. But later on, the numbers start growing faster than expected. You might deposit $1,200 over several months, yet discover your account has increased by $3,000 or more. When this happens, it's a clear sign that compounding is accelerating, and the growth curve is beginning to bend upward. At the beginning of an investing journey, people tend to check their accounts frequently. Sometimes they look at their portfolio every day, watching every small movement in the market. Each decline feels significant, and each increase brings temporary relief. However, experienced investors behave differently. After observing markets rise, fall, recover, and grow again over many years, they develop confidence in the long-term process. Eventually, they stop checking their accounts constantly. This doesn't happen because they stop caring. It happens because they stop worrying. Research has shown that investors who monitor their portfolios too frequently often make more emotional decisions. They react to short-term changes and trade more often, which can reduce their long-term returns. Investors who check their accounts less frequently tend to make fewer emotional decisions and often achieve better results. Another sign of advanced compounding is when earlier financial goals start appearing small. In the beginning, goals like reaching $10,000 or $50,000 feel enormous. Later, those milestones are reached faster than expected, and new goals must be set. As compounding accelerates, investors begin realizing that growth can exceed their early expectations. Eventually, their thinking evolves even further. Money stops being only about personal security. Instead, they begin thinking about the future beyond themselves. Questions shift from, "Can I afford this?" to, "What impact can this wealth create?" They think about family members, future generations, charitable causes, and communities they want to support. At that stage, compounding has moved beyond financial growth and into financial freedom. The truth is that most people never reach this stage, not because compounding fails, but because they abandon the process too early. They panic during downturns, become impatient, or chase new strategies that promise faster results. Compounding only requires consistency, patience, and time. Those who continue long enough often discover that the small snowball they started years earlier has grown into something far more powerful than they ever imagined. And if you want to understand the hidden investing principle that quietly multiplies wealth for ordinary people, there's one simple rule almost no one talks about, but it changes everything.